Hello and welcome back to another video. Today I'm going to be explaining exactly how car loans work. Now by the end of this video you're going to understand everything you need to know about car loans, such as what they are, what types you can get, how you can qualify, as well as the pros and cons. So make sure you watch this video to the end so you don't miss any important details. So to start with, what is a car loan? A car loan is the type of secured loan that allows you to borrow money to purchase a car. The car itself serves as collateral, meaning that if you don't repay the loan, the lender can repossess the car. Car loans are typically offered by banks, credit unions and car dealerships. You'll be able to repay this loan plus interest over a set period of time, which is typically 3 to 7 years. So what type of car loans are there? Car loans come in various forms, each with its own set of terms and conditions. Here's an overview of the most common types of car loans. To start with, you have the traditional car loan. These are the most straightforward and widely used types of car loans. You borrow the full purchase price of the car and repay it over a fixed term, which typically ranges from 3 to 7 years. Monthly payments consist of principal, which is the amount you borrowed, and interest. A traditional car loan is a good option for those who want to own their car outright and are comfortable with fixed monthly payments. Next up, you have the car lease. With a car lease, you don't purchase the car entirely. Instead, you rent it for a specified period, which is usually 24 to 36 months. During the lease term, you make monthly payments that cover the car's depreciation, which is the loss of value over time. At the end of the lease, you have 3 options: return the car, renew the lease, or purchase the car for a predetermined price called the residual value. Leases are often attractive to those who want lower monthly payments and the flexibility to drive a new car every few years. So how do you actually qualify for a car loan? Qualifying for a car loan depends on several factors, including your creditworthiness, income, and employment history. Here's a breakdown of the key factors lenders consider. To start with, your credit score. Your credit score is a numerical representation of your credit history, indicating your ability to repay debt responsibly. A higher credit score generally translates to lower interest rates and better loan terms. Aim for a credit score of 670 or higher for favourable car loan options. Next up, you want to consider your debt to income ratio. This ratio measures your monthly debt obligations against your gross monthly income. Lenders typically prefer a DTI of 43% or lower, indicating that your debt payments won't strain your finances. You also want to consider your income stability. A steady and reliable income demonstrates your ability to make consistent loan payments. Lenders prefer borrowers with stable employment history and a consistent income stream. Next up, you have to consider your down payment. A down payment is an upfront amount which you contribute towards the car's purchase price. A larger down payment reduces the amount you need to borrow, which can lower your monthly payments and interest charges. And finally, you want to consider the type of car you are loaning. The type of car you choose can influence your loan eligibility. Luxury or high performance vehicles may require a higher down payment and a stronger credit score compared to standard or fuel efficient models. So now that we know exactly what car loans are, what are the main benefits that come from using them? To start with, you can spread out payments. Instead of paying the full purchase price up front, car loans allow you to spread out the cost over a fixed period, typically ranging from 3 to 7 years. And this can make it easier to manage the financial burden of buying a car, especially if you have limited savings. You also could get access to different cars. Purchasing a car with cash may limit your choices to less expensive options. With a car loan, you have access to a wider range of vehicles, including newer models, luxury cars, or those with specific features or capabilities. And finally, it can be good for building credit history. Making timely car loan payments can help improve your credit score. A good credit score can open up doors to better loan rates, lower interest premiums, and more favourable terms for future financing needs. So what about the main disadvantages of car loans? To start with, loan payments. Car loans involve monthly payments that can add significant financial strain, especially if you have other debt obligations. Late or missed payments can damage your credit score and lead to repossession of your vehicle. There's also interest charges. Car loans typically have interest rates that you pay over the loan term, and these interest rates can add to the overall cost of the vehicle, reducing the amount of equity you build in the car. And finally, depreciation exposure. Cars depreciate over time, meaning their resale value declines as they age. With a car loan, you're responsible for paying off the full loan amount, even if the car's value depreciates significantly. So this has been my video explaining exactly how car loans work. Hopefully now that you've watched this video, you have a good understanding of how they work, and hopefully this knowledge can assist you when you're looking to get your own car loan. So I hope you found this video helpful, and if you did, please comment down below to say this video helped you out, like and subscribe for more content like this. Thanks for watching.